Hello, everyone. Thanks for joining me today to talk about this very hot topic, the 10-year rule for designated beneficiaries. The last time I had a presentation on the proposed regulations, it took me over an hour, and there was just too much information. So one of the things I decided to do was to break this out into different sections. This way, when we have a conversation, we focus on just one topic, deal with that, and then next week we focus on another topic. And I think most of you agree that that makes it easier for everyone. So for today's presentation, I'm going to be talking about the 10-year rule for designated beneficiaries and how the proposed regulations change the interpretation from what the industry thought it was. So just a little warning, the rules might change. The part of what the Treasury asked for was comments on the proposed regulations, and they got a ton of comments. Now, I don't think that in itself is going to change the rules, but you know, the Secure Act, for instance, was one of the things that changed the rules that apply to beneficiary options. And as you guys know, part of what I try to do is to make sure that when rules change, you get notified of what those changes are and how they affect your clients. So I'm here for that. But for today, we're going to be looking at, well, who is a designated beneficiary and what's the big deal about the proposed regulations? How did they talk about the at least as rapid the rule? And how does that change what we're telling our clients now versus what we told our clients when the Secure Act was signed into law in December of 2019? And just a reminder, when I talk about beneficiary options for IRAs, the options for Roth IRAs are the same as those that apply to a traditional IRA when the traditional IRA owner dies before the required beginning date. And that's because there's no RMD for Roth IRA owners. So always bear that in mind. Now, as a reminder, the Secure Act was signed into law in December of 2019 and became effective of January 1, 2020. So we didn't even get enough time to implement all those changes. Now, what we're hoping for is that when the final regulations are issued, they do that like the 1st of October, so that we have time to notify our clients and get everyone, including the IRA custodian system, up to speed, if that is even enough time. So the Secure Act made quite a few changes to IRAs, one of which is they changed the distribution options that are available to beneficiaries. Most impactful is that they took away the distribution for the option for a designated beneficiary to take distributions over their full life expectancy. And so now designated beneficiaries are subject to a maximum of a 10-year period. Now, when someone asks you, what are my distribution options? I just inherited an IRA. We have to get certain information from them in order to even begin to answer that questions. And for that reason, I want to remind you that when you have IRA custodians calculating RMBs for beneficiary accounts, double check to make sure that they have the right information on file. I'll give you an example. Let's say we're looking at a beneficiary account and the beneficiary's date of birth is December 31st, 1970. How do we know that that's the age we're supposed to use? Why is that a question? Because it could be a beneficiary IRA for a successor beneficiary, meaning the person who inherited it from the original beneficiary. And we know we never use the age of a successor beneficiary. And unfortunately, as nice as it is for custodians to calculate RMDs for beneficiary accounts, I find that those that do are not asking all the right questions, including date of birth and date of death of the account owner. they do get the date of birth of the beneficiary, but is that the date of birth of the original beneficiary or a successor beneficiary? Because there are a lot of inherited accounts out there that are owned by successor beneficiaries. Is the beneficiary the surviving spouse of the account owner? Was the beneficiary disabled or chronically ill if the account was inherited after 2019? And if there are multiple beneficiaries, do any of the above apply to any of those beneficiaries? And were there separate accounting by December 31st of the year following the year of death? Because that could change whose age is used to calculate or determine the RMD for that particular beneficiary's account. And of course, whether the beneficiary is a successor beneficiary. The required beginning date is still important. For those who reached age 70 and a half by December 31st, 2019, the required beginning date is April 1 of the year that followed the year in which they reach age 70 and a half. For those who reach age 70 and a half after 2019, the required beginning date is April 1 of the year that follows the year in which they reach age 72. Why is this important? Because the distribution options that are available to a beneficiary is determined by whether the account owner died before the required beginning date or not. Now, if you'd asked me that question on February 23rd, 2022, I would say, oh no, it doesn't matter for a designated beneficiary. Why? Because the Secure Act says that the 10-year rule applies to a designated beneficiary, and the rule is the same regardless of whether the account owner died before the required beginning date. But on February 24th, the Treasury published proposed RMD regulations that says, not so fast, Denise, you are wrong in that. You and everybody else who have been telling people that under the 10-year rule, distributions are optional until December 31st of the year following, of the 10th year following the year in which the IRA owner died. Well, half right? Because those rules are still true if the account owner died before the required beginning date. But if the account owner died on or after the required beginning date, then the rules are different. I'm going to be talking about that in a second. So we need to know who is a designated beneficiary, because that's who we're talking about here today. And so for that reason, I included all the classes of beneficiaries here so we can see, well, what's the difference between a designated beneficiary and other designated beneficiary. From the category here, we have designated beneficiaries, eligible designated beneficiaries, and non-designated beneficiaries. So a beneficiary is a designated beneficiary if they're a person or a qualified see-through trust. And the determination of whether an account has a designated beneficiary is still made as of September 30th of the year, following the year in which the IRA owner died. Now, for RMDs for the year of death, just a reminder that if you have a client who died this year and the beneficiary asks you, then what are my next steps? Part of your question, part of the conversation has to be, well, what is the date of birth and date of death of the account owner? Because you need to know if the account owner was supposed to take an RMD for the year of death. And if they didn't, then that RMD must be taken by the beneficiary, generally by the end of the year in which the account owner died, and it must be calculated as if the account owner lived through to the end of the year. So even though the beneficiary is taking that RMD, we're still going to calculate it as if the owner lived through to the end of the year. Now, one of the bonuses that we got from the proposed regulations, because it's not all bad, is that before the proposed regulations, if this RMD for the year of death was not taken by the end of that year by the beneficiary, then the beneficiary would be subject to a 50% excess accumulation penalty. But now the beneficiary has an extended deadline. As long as the beneficiary takes it by the tax filing due date plus extension for the year of death, then the excess accumulation penalty does not apply. So one of the questions I get often is, well, what about the Secure Act rule? Does it still apply? Well, yeah, for those that died before 2020, and if the beneficiary also died before 2020, then the pre-Secure Act rule still applies. So let me qualify that, because I think I heard myself saying something wrong. If the account owner and the beneficiary died before 2020, then the Pre-Secure Act rules apply. Right? If the account owner died before 2020, it applies to the account owner. If the beneficiary also dies before 2020, then guess what? You can still have that stretch IRA conversation with your clients because both the account owner and the beneficiary died before 2020. But for Secure Act rules, they apply to account owners and beneficiaries that die after 2019. Now, here's the language for the Secure Act, which fooled all of us. The 10-year rule, which is like the old 5-year rule, applies regardless of the age at which the IRA owner died. And under that 10-year rule, distributions are optional for years 1 through 9 until the end of year 10, at which time the entire balance becomes the RMD and has to be distributed. Then the proposed regulations were signed into law. And under those proposed regulations, the IRS says, hang on a second, the at least as rapidly rule applies. What does that mean? It means that if the IRA owner died on or after the date on which they're supposed to start taking RMDs, then the beneficiary has to continue taking RMDs at a rate that is at least as rapid as the rate that the owner was taking RMDs. Now we know that the owner is going to use the uniform lifetime table or the joint life table if applicable, but the beneficiary, can only use the single life expectancy table, which means that in most cases, depending on the age, the at least as rapidly means that the beneficiary is going to be taking distributions likely at a much faster rate. So what are the distribution options now for a designated beneficiary? It depends on whether the account owner dies before 2020 or after 2019. So let's focus just on the Secure Act rules, because we're already familiar with the rules that apply when the account owner died before 2020, right? Under the Secure Act, if the account owner died before the required beginning date, it's a straight 10-year rule. Distributions are optional from years 1 through 9, and the account must be fully distributed by the end of year 10. Now, straight is my terminology. You won't see that in the proposed regulations, but I had to make up something to make it stand out from what I call the combined rules, which applies when the account owner died on or after the required beginning date. And under that combination rule, the 10-year maximum still applies, but the beneficiary also has to take distributions over their life expectancy, which means they have to take distributions from years 1 through 9 that is no less than the calculated RMD amount using their life expectancy. But guess what? They still have to fully distribute the account by the end of year 10. Now, for when the account owner dies before the required beginning date, there's no calculation. It's really simple, right? So you as the advisor, especially if you're working with the tax advisor, is, well, what do I tell my client? And for traditional accounts, it really comes down to taxes. Do I wait until the end of the 10-year period, as in this example, where I just take the lump sum amount? For a Roth, it's an easy answer. Everything's going to be tax-free and penalty-free, so you can wait. But when it comes to a traditional IRA, the question becomes, well, do we want to wait until the end of the year to bunch that up, or should we spread it over a 10-year period, as in this example, to mitigate the amount of income taxes that should be used? So that has to be part of the conversation. Now, if the account owner died on or after the required beginning date, one of the questions is, well, how do we determine how much should be taken each year? You make that determination by calculating the amount over the beneficiary's life expectancy using the single life expectancy table. And I'm going to send you a copy of that after we're done. So here's how this works. If the account owner dies in 2021, for instance, you determine the beneficiary's age in 2022 using the single life expectancy table, subtract 1 for every subsequent year. That's referred to as the non-recalculation method. And whatever the factor is, you divide the fair market value by that life expectancy. Here's an example where Sandy died at the age of 75. Her beneficiary is her 64-year-old brother, Larry. He's not disabled or chronically ill, so he's a designated beneficiary. Sandy's remaining life expectancy is 14.8 years. Excuse me. Oh, I'm so sorry. Larry's life expectancy is 22.9 years. Now, the regulations say that you use the life expectancy that is, excuse me, the longer of the two. So we're going to be using Larry's life expectancy. And now you're saying, oh, well, Larry can take distributions over 22.9 years. Not so fast. When he's taking the distributions, he can use the life expectancy of 22.9 years. But remember that he has to fully distribute that account by the end of year 10. Now, one of the questions for Larry is, well, as I'm taking those life expectancy distributions, should I take the minimum each year, or should I spread it out so that we have almost an equal amount each year? And here's a calculation that shows Larry taking the RMD each year. And at the end of in year 10, he has to take $60,000. So that's a bunched up amount. So the question becomes, even though the RMD is $4,300, should Larry take more? Because with the RMD, you can always take more. You can't take less, or you're going to be subject to a penalty, but you can take more. And so the question for the tax advisor is, well, based on projections, what is going to be Larry's income tax rate? What are other income amounts that we should take into consideration? And based on that answer, the answer to the question is, should Larry take only $4,300, or should we have him take more so that by the end of year 10, he's not taking $60,000, which could potentially mean paying more income taxes than he would have paid had he spread it out equally or at some other tax efficient rate. Now, one of the hot issues that came up out of the 10-year rule, and this when the account owner dies after the required beginning date, this requirement that the designated beneficiary has to take annual RMDs. Well, we have been telling clients that they don't have to, as long as they're a designated beneficiary. And now we have clients where the owner died in 2020 and the beneficiaries didn't take anything in 2021. And now you're telling me that they might be subject to a 50% excess accumulation penalty. Well, that could be true, but remember that the IRS also says, and the tax code confirms or supports that, if the deadline is missed due to reasonable cause, then they'll waive the penalty. So all the tax advisor or the tax preparer has to do is file Form 5329 and request a waiver of the excess accumulation penalty. Now, that penalty is missed if the debt is waived if the deadline is missed due to reasonable cause. And this definitely is a case of a reasonable cause, where the entire industry were telling these individuals that they didn't need to take RMDs. So the question now becomes, what do we do going forward? Well, I find that working with cheat sheets are very efficient because it helps you to remember things that you need to tell the clients, because you guys are dealing with a million things. And so even if you have the fundamental understanding, it's great to have a cheat sheet beside you that reminds you, for instance, what are the questions that you need to ask your clients? What are the solutions if a client misses their deadline? And how do you move forward depending on your beneficiary status? Now, of course, we're going to be looking out for more changes, and as soon as they come about, I'll make sure you're notified of those. And I'll be working on those cheat sheets for you. I already have those. You already have some of them. If you have ideas of cheat sheets that you want me to create, just let me know and I'll work on them for you. Now, again, this is only on beneficiary options for designated beneficiaries. My next session is going to be beneficiary options for eligible designated beneficiaries. And I hope you like this format where we break it down so we can just focus in 15 minutes. I'm over by 4 minutes. I promised you 15, but hopefully you won't mind. And if you have any question at all, please shoot them using the chat feature and I'll answer those questions for you. Okay. All right, good job, Denise. That's short, which was longer. What do you do if the owner died before 2020, but the beneficiary died after 2019? It depends, and you're talking about the successor beneficiary options, which I'm going to be covering in one of my sessions, but it's a very important question. Now, for successor beneficiaries, you want to determine the distribution options that were available to the original beneficiary. And that helps you to determine what's available to the successor beneficiaries. For instance, if the original beneficiary is subject to the 10-year rule, then the successor beneficiary would continue taking distribution under the schedule available to the original beneficiary. They cannot go beyond that. So your client inherits the account and the owner died before the required beginning date, and they were subject to the straight 10-year rule. If they die in year 5, then the successor beneficiary has 5 years to take the remaining balance. If the account owner died on or after the required beginning date and were taking distributions over their life expectancy, then the successor beneficiary has to continue taking distributions over that life expectancy or faster. Now, remember too that there are some scenarios where if the account owner died on or after the required beginning date, distributions are taken over the longer of the life expectancy of the beneficiary or the remaining life expectancy of the decedent. If the life expectancy factor that is used is shorter than 10 years, then the account would have to be distributed during the shorter period. So we always have to look for that. Just because it says 10 years, if the account owner dies on or after the required beginning date, doesn't mean that they get the full 10-year period, because we have to take the life expectancy factor into consideration. How do you calculate the RMD when the account owner dies at age 65? Well, in that case, the account owner would have died before the required beginning date, so there's no calculation. All you need to tell your client is you got to make sure you empty the account by the end of year 10. But there's a tax question in there as well. If we're talking about a Roth IRA, we know that Roth IRA distributions are completely tax-free and penalty-free once the distribution is qualified. And one of the requirements that makes a distribution qualified is if the distribution is due to death. Another is if the account owner held the account for at least 5 years. Now, the 5-year period for qualified distribution starts when the account owner funded the Roth IRA. It does not start over when the beneficiary gets the account. So if you have a client with a Roth IRA where the account owner had already met the 5-year period and is now deceased, then you know distributions from the beneficiary account would be completely tax-free and penalty-free. I'll talk about the exceptions that apply to spouse beneficiaries when I look at spouse beneficiary options. Do we know when the IRS will update the proposed ALR rule to definitively say whether the RMD for a designated beneficiary for an IRA owner who died after the RBD must be taken in years 1 through 9? Unfortunately, I don't know when that's going to happen, but here is another question. Will they change it? Because one of the debate that came out of the proposed regulations is the proposed regulations right? And when you line up the Secure Act with the proposed regulations, it does appear that they are right, because there's no language in the Secure Act that says they're going to repeal the at least as rapidly rule. Now, you might remember one of the big things that came out a couple of years ago was when the IRS published Publication 590, and one of the examples that they included in Publication 590 said, oh, if you inherit an IRA from your brother and you're a designated beneficiary, you have to take annual RMDs. And there was a big brouhaha about that. Now it's turning out that the Publication 590 might have actually been right. So Publication 590, even though it's not authoritative, says that that's a requirement. Now the proposed regulation says it's a requirement. It seems to me that they're trending in the direction where their interpretation is that that's permanent. And if you look at the tax code and compare it with the Secure Act, I don't see where it was repealed. So I'm leaning on the side where I kind of agreed with them, but the Secure Act did a very bad job of the language that they used. Confirming what you just said, original beneficiary dies in year 2, then their beneficiary has to empty the account in the 8 years remaining. The 10-year does not start over. That's true. If the original beneficiary is subject to the 10-year rule and has the full 10 years, then the account cannot go beyond that. So if they die in year 2, the successor beneficiary has 8 years to empty the account. The 10-year period does not start over. Part 2 of that question, and RMDs are on the initial beneficiary's life expectancy. Now that's true if the account owner died on or after the required beginning date, because then we're using the life expectancy of the beneficiary. Now the regulations say the longer of the life expectancy of the beneficiary or the remaining life expectancy of the decedent, but we know it has to be the life expectancy of the beneficiary. Why? Because if they were older, they would be an eligible designated beneficiary. The fact that they're a designated beneficiary means that they're not older. If so, how about if it was disclaimed? Well, if an IRA is disclaimed timely and all the requirements are met for a disclaimer, then the original beneficiary is treated as if they predeceased the IRA owner. So if they're properly disclaimed, if the IRA is properly disclaimed, we're not looking at the original beneficiary to determine what the distribution options are. We're looking at the party that becomes the beneficiary as a result of the disclaimer. Whose life expectancy is used for RMDs during the 10 years? I think you're reading my mind, because I think I answered that already, but we're going to use the life expectancy of the beneficiary, not the life expectancy of the account owner. It's a little bit different when we're talking about eligible designated beneficiaries. So I'll get into that next week when I talk about eligible designated beneficiaries. These are great questions. Any more questions? I welcome more questions. If you think of any question after this, please, you can always reach out to me. I welcome the questions. I want to know where your mind is and what you want to know. And I'll share the Q&As with everyone too. We're at the 30-minute mark. I'm here for longer if you want to. I just wanted to make this short and spicy. So for next week, we're going to be doing eligible designated beneficiaries, and we might need 20 minutes instead of 15. Thanks everyone for your time. If you have any more questions, I'll be here. Thank you. Thank you very much. Appreciate it.